What's up, everyone? I'm going to go ahead and just start doing this, and then at the end, I will take questions for anyone in the group that has a question about this. I'm just going to kind of go through the whole thing, and then I'll take some questions on it. So, we're discussing the core logic. This is something that I created last year, and actually it's about around this time when I was experimenting with it. And let me make sure first, before I go any further, that I'm actually live and streaming. Can anyone in the group confirm that I'm live in the chat, if you don't mind? That would be great. Like, that you can hear me and everything is working visually. Because I'm notorious for starting shit like this and not having things displaying properly. So I think we should be good. Just let me know in the chat if you can. I'll check the YouTube side as well, just to make sure. Thank you, Object. I appreciate it. We're good on YouTube? Alright, cool. Appreciate it, y'all. Okay, so this strategy is very specific to the situation in the market. It wasn't just made randomly. Obviously, from the losses that I incurred from 2021, I'm sure, like everyone else, during Bastille Day around that time, my account hit all-time highs. I didn't sell, and then you know what happened after that. So the point was how to learn and figure out how the hell can I play these markets to make money and gain that money back. Well, CoreLogic has provided an 85% win rate consistently for a year, and it's using metrics specifically around the current situation. And I'm going to go through that stuff first, so you can get an understanding of why it works. So let's go ahead and do that real quick. And to begin with, first of all, the number one reason why this works is because of the current situation with the repo. And that's kind of where I started wanting to build my strategy around, was the repo market, because I saw the unprecedence of it. If you look on the chart, everyone's seen it. Nothing even comes remotely close in history. So basically, I'm going to walk you through this. I'm going to show you that there is, in fact, non-cash collateral in the repo. And again, what a repo market is, it's basically cash for securities, right? So you have the Fed desk. They're the lender of last resort. You have the money market funds here that are the primary counterparties to the Fed. BlackRock, Fidelity, Vanguard, State Street, all that good stuff. And actually, I'm just going to go ahead and show you the source data for that. And this is Office of Financial Research, U.S. Money Market Fund Monitor. You can specifically track this stuff, and this is the repo market. This is any investments by money market funds here. But if you go here to the drop down and go to Federal Reserve Repo Facility Utilization, or you can use the repos with the Fed, or the U.S. MMF's investments in the repo market as a whole. So remember, the Fed on RRP is not the only repo market. There's multiple ones. There's the FICC from the or the GCF repo from the FICC, which is cleared by the Bank of New York Mellon. Then you have the on RRP repo, and then you just have the standard repo market. And also, so whenever the repo transaction is done, always a reverse repo is always done at the same time as a repo. So if the Fed is the one taking in the cash, which is the situation right now, they're the ones conducting the reverse repo, and then the ones putting the cash with the Fed and taking the assets or the treasuries from the Fed or the money market funds, that's your repo side. So as of right now, the way the current situation is, the Fed's got the cash because obviously interest rates are rising, and then the treasuries are held by the money market funds, which is reflected in their portfolios. And I'm going to show you that real quick. So first we look at Fidelity. That's number one. Let's go to the repo market investments. And we have three types of repurchase arrangements that are basically available. You have treasury, government, and then other. We're going to look into other for the strategy. The strategy is relevant to the other, but the treasury repurchases is how you can tell that indeed the Fed does have the cash and the counterparties to the Fed have the treasuries. So we're going to open this up. We're going to drill down on the data, and you can download the principal data too, but you can drill down further to the counterparties. These are going to be your counterparties to the repo market. So obviously number one is going to be the Fed, because again, remember, if you're on the repo side, you're the one giving the cash. That means your number one counterparty is going to be the Fed if they're the ones lending from the desk. And these are your banks. So notice, the repo market side has all your banks. You have Federal Reserve, BNP Paribas, this is the FICC, Barclays, Credit Agricole, JP Morgan, all your big banks, right? Now you go to the reverse repo side, the opposite end, with the Fed Reserve, and then you see all your money market funds. Fidelity, BlackRock, JP Morgan, Vanguard, Goldman Sachs, all your money market funds are here. And then all of your, I'm going to duplicate this so I can show you both. And then this one is the repo market, Treasury, because the Fed deals with primarily Treasury, but not only Treasury. So here is one side, Fed Reserve and all the banks. Other side, all of the money market funds. Now we're going to look into Fidelity, go to details. We're going to drill down to see which fund we can go and look at to verify everything that I just said. So we're going to drill down here and we're going to see Fidelity Government Money Market Fund. That should be, I believe that's the SPACs. I can't remember off the top of my head. Everyone should know what SPACs is. Okay, Government Money Market Fund. It's going to be this one. Yes, it should be the number one player in the repo. So we're going to go to SPACs real quick from their website. Always look on the issuer website. You're going to find the most accurate data there. And I'm going to jump into the strategy soon. I'm just giving you a little backstory of why this works. So we're going to go to the prospectus. Then we're going to go to the monthly holdings report. And then I want you to look at this. I'm not bullshitting. So here are the treasuries that they're holding on their balance sheets, on their reports, monthly holdings for September 30th. This is reported once per month at the end of each month. Federal Home Loan Bank, you have a lot of Federal Home Loan. And then look, see those banks? BNP Paribas, Barclays, ING, Federal Reserve Bank of New York, right there. I'm going to zoom in a little bit. See the Fed right there? Fed Reserve Bank of New York. And then we go back to the website with the counterparties on it, and we go to the Fed side, and we can see that Fidelity is the number one. And if you look at Fidelity's side, where'd it go? Fed is number one, because look at the weighting of it. Look, I mean, the money is, you got 132 billion, and nothing else even comes close. But the interesting thing is that look what else is in there. You have BNP Paribas, right? Let's go back real quick. So Federal Reserve, BNP Paribas, FICC, Barclays, all the banks. Go back to Fidelity. Right here. In a joint trading account with Citigroup, JP Morgan, Bank of New York Mellon, which is the FICC. Remember, they clear for the FICC. So what I'm trying to say is this is all one giant, big connected clusterfuck of cash, collateral, segregation for all the new capital requirements and all that shit. Now, obviously, doing this is going to create effects in the market, like rifts in the market. And that's what I started to look for. And I found them around earnings. And we're going to get into that real quick. I think that's all I needed to go over with the repo. Just think of it as a big-ass clusterfuck of cash collateral swapping, and the banks, market makers, the Fed, everyone's involved together. It's a big-ass party, and it's basically what's keeping the market the way it is right now. They take in all the liquidity, and they keep it in a cage. So let me find the diagram so I can show you real quick. Sorry, I had too much shit open. I'm going to close this one down. Don't need that. Here's the diagram here. This is actually a white paper from the same website that I showed you the data from. Let's see if we can find the chart. A lot of good reading in here. There it is. So this is the old one. This is the old one. There's a newer one. It adds in the agent lender right here. So this is the new one. Big ass clusterfuck of a chart. I don't know why it's so blurry. I don't think it should be that blurry. But anyways, the big middle here, that's your securities dealers, your big banks, Then you have your interdealer brokers, FICC clearing, securities borrowers are the hedge funds and broker dealers. The cash lenders are the money market funds and the bank portfolios. But now what do you notice about cash lenders? Who are they lending the cash to? The Fed. And who's the Fed lending the treasuries to? The money market funds. The market's fucking backwards. That's why outflow is inflow and inflow is outflow, because what they're doing is operationally shorting the market. That's all you need to know about the repo. It's a giant operational short, segregate collateral, everyone's involved, and it's to trap liquidity. And I firmly believe, based on my research, that it is the source of inflation, because if you look at what's happened this year, inflation's gone up and up and up, short interest has gone up and up and up, but what hasn't gone up? The fucking markets. So again, it's just two and two together. So the second thing is that if you were to have everyone in the market participating in some kind of clusterfuck like this of cash and collateral, that must mean that there must be evidence somewhere of not a lot of shares trading on the open market. And we do in fact get this by looking at any query, any institutional ownership reporting data service will show you that this is the case. So let's use our query tool real quick. Queer. Just kidding. Okay, we're going to do this. We're going to search for institutional ownership is greater than. Let's just say, really, 50% should be the number to do, but we're going to do fucking 75%. If it's greater than 75%, it's going to return us the stock. So we have 1,773 entries with more than 75% of the company owned by institutions. And you can obviously look into Fidelity, BlackRock, Vanguard, and then you're going to notice that, holy shit, it's the money market funds. That's where all the collateral is. It was literally encouraged by the Fed. So we have repo, we have high institutional ownership, and we have earnings so far. So now what we can do is start actually getting into the strategy and from a trading perspective, because this is literally all that is a factor when it's regarding the mechanics of why this works. High institutional ownership, not a lot of shares freely trading, and we're hitting these very illiquid, not always, but most of the time it will be illiquid, so you need to pay attention to things like spread, but that doesn't mean it's not profitable. Again, 85% chance if done properly. And patience is definitely a strong suit for the strategy. So again, we have 1773 stocks with more than 75% ownership. Let's change that to 50. Now we got 3,257 stocks with more than 50% held by institutions. So anyways, that's definitely concerning. So what's the first thing you do with CoreLogic? Well, first of all, we need to go over where you find plays, but before we can do that, you need to understand what you're looking for. So without even using the screener, I'm going to show you, so we started this, we didn't have the screener. We looked a different way. I'm just going to kind of walk you through it. So whenever you're first using your charts, and I recommend WeBull. I've recommended WeBull this whole time. There's a reason for it. They have the best data. TradingView does not even report the TRF data, which is 40% of market volume. I mean, you can take that for what it's worth, but it is what it is. I would much rather have more of the picture of volume data than a community like the TradingView likes to sell people on. But anyways, WeBull is my brokerage of choice. It's been very effective. They have a lot of good tools. And I'm going to go through the chart setup real quick. So if you're WeBull, if you're new to WeBull or you just switched over, literally on your little bar here on the PC, and also this is probably important to point out, I do not trade on my PC. I execute from my phone. I only chart from the PC. But lately I haven't really been charting much at all because, again, I've been doing it for so long, it's just a habit at this point. But if you are using the computer, you're going to want a few tabs up top, one being obviously the chart. Note, I really don't think that's necessary. News, news is okay to have if you want to just quickly reference the headlines for like a narrative scan, but I wouldn't read into them and actually take into account what they're saying, because as we all know, being in this group for so long, the news is bullshit. So we're going to add another one that you're going to need, options. Now, core logic does work without playing options. If you want to short an up gap, it's actually less risky because you don't have theta to worry about eating your asshole the whole time you're waiting for the puts to come down. And as we all know, puts take a little bit longer than calls. So again, I started this strategy by shorting the up gaps. That's how this began. And then I tried to, fit it in with the call side, and then I figured it out and connect them on both sides. It's literally just a yin-yang of the same characteristics. So you want your options chain tab, you want your news tab optional. I usually don't use it. Obviously your chart tab, and then you're going to want your volume analysis tab, and you're going to want your calendar. And this is if you're not using the screener. This is for anyone that may not be in the group or whatever, or if the bot's down or something and you can't get a hold of me. This is how the original way began of finding the criteria. Whoops. Let's do. Sorry, my wife just left. Okay, sick. Calendar. Whoops. So this is your earnings calendar. Now, literally, all you do, I like to put the calendar next to the chart, is you just look, and I'll tell you what you're looking for. So as far as the setup, not much at all required. My personal way I like to set it up is you right-click the chart anywhere on your desktop, go to chart settings, make sure extended hours is set. And I've set this back to default so I can show you how I set it up. Show extended hours. I personally like to take the grid lines off, but that's just me. You can do if you want to keep them on, it's totally up to you. You obviously want the corporate actions on, splits, earnings, dividends, and then everything else basically just leave how it is. Except as far as the gaps, this is the other reason why I really like WeBull, because of this feature here. It makes it to where it's almost impossible to miss a gap. So again, this is what it looks like. Show 5 gaps, show extended hours, show high-low price, overlap volume, and the corporate actions. As far as indicators, RSI and MACD. And really, honestly, if you're just now beginning core, you really don't even need the MACD, honestly. It's just a secondary indicator to help confirm if it gets a little wishy-washy, but lately, I mean by lately, like the last 3 to 6 months, I've rarely even used the MACD when timing my entries. So anyways, let's go ahead and see what we're looking for here. So we have the RSI. It's turned on here at the bottom. That's what this line is here. If you're not sure what the RSI is, it's a relative strength indicator. If the line gets here to 70, it's considered overbought. If it gets here to 30, it's considered oversold. That is the first thing you're going to want to have as far as criteria. But on top of that, you also have to have a daily gap or a 4-hour gap. So if you're looking for gaps and you're going out of the 1 minute and you find a gap, that's not core just because there's a gap. Core daily, and rarely, but sometimes, but not always, definitely less times than the daily. You can also reference the 4-hour to see if it's there. Actually, let me add the 4-hour here so I can make this a little easier. So basically, the 4-hour and the daily. And if you have to help yourself remember, take as many of this extra shit off that you don't need if you're trying to remember how this process works, because it is about consistency. So I'm just going to go ahead and take everything off but the 4-hour, the daily, and the weekly. I guess you can't turn the 30-minute off. Okay, there it is. The weekly. Okay, so I got daily, weekly, 4-hour. Because sometimes there will be a weekly gap that you can't see on the daily. So far we've got gap detection, we have RSI, and that's it. So let's look for some plays. And the third thing, you're going to want to play off of fresh earnings. So fresh earnings, RSI, gap. Those 3 things primarily is what you're going to look for as far as your chart criteria. So before we had the screener, I would just sit here and I would just go down this list. for earnings. So this one, let's start from tomorrow. I'm sorry, not for. You definitely want to play after earnings, not before. Never play these plays before earnings, always after. So we just had earnings today for a lot. Let's check yesterday's earnings on the 19th. So SAL, and obviously we already know what the plays are. I'm just doing this for anyone that may not be in the group who's familiar with the current plays. Okay, so here's the gap, but there's a problem. The RSI is not overbought yet. It's still at 68.96. So this one is automatically a no-go. And again, you may think it's silly to let that minor of a difference make or break your decision for playing this play. But I mean, again, why it's worked so well for me is I've stayed consistent to what works. And maybe I've left money on the table, maybe not. But either way, I mean, consistency is what you want in these markets. So there's one there, but it doesn't quite meet. So this is the old methodology for looking for plays. Chart to calendar from the recent earnings to see which ones meet the criteria that we're looking for. But since the development of the screener, let's go ahead and check it out. So if you remember, obviously you have free access to this when you sign up with the group, and all you got to do is run the /fudstop command to find the credentials to log in. Once you've logged in, you just go where I just went here to the saved screens section, and you'll see a CoreLogic call screener and a CoreLogic put screener. And you can run these directly from Discord as well. I'm not going to run the command for demonstration here because I don't want to give the password away and have to change it again and confuse everybody. But you can call it from within Discord using the fudstop command. So this is a daily thing. These update automatically once per day. So and usually they update around market close or so, around 7 p.m. Central. But not always. Sometimes it takes a little bit longer. But that's okay, because remember, this in and of itself helps us and prevents us from playing anything that just may have earnings like the next day. Because the worst case scenario is you may think something's core, you get into it because it looks good, but then earnings was the next day, and then you get IV crushed to piss and you're fucked. So you definitely want to play before earnings, and that is what this screener is looking for. These screeners are looking for plays that have just came off of earnings, and they're going to all automatically either be oversold or overbought. So all you're doing is looking for those gaps. This is eliminating 2 out of 3 of the criteria that you need to start the second part of the process. So let's run the call screener real quick. And it looks like it has not updated yet. Still as of 22/10/19, so it should update in about an hour. But we made bank today in the group. I mean, let's go look. Did anyone post their gains from SI today? And it was a quick one. You got to pay attention to the momentum, because if it comes quick. See, oh, WAFD printed today for you, buddy. Oh shit, nice. Oh, yeah, that's right. You did hit that. I sold that too early. I sold it too early. Anyone post their SI stuff today? Holy shit. I see like Amazon, WAFD. WAFD was a core though. It's a core put. No SI gains. I know people made money on SI today. We just don't have any screenshots yet. That's okay. But yeah, SI was great. It ran quick. The financial services sector was weird this run, but good shit today. I saw a lot of people were winning off of SI. Where'd my screener go? So anyways, SI, let's go to it on the chart. SI. So as you can see here, and let me see if I can turn these green dots off. Looks like these red dots and shit, just ignore those. Those are just built-in WeBull signals that you can use. I ignore them. I don't use anything extra than what I just described in this video. But you see how the RSI here is below this line? It's oversold. It's currently sitting at 29.40. So if you bought SI today, it's still a core play despite having 2 green days. And this in and of itself, I want you to look at this picture here. This in and of itself is core logic. This picture. Because what happens? The stock gaps down or up in the case of a put, which that's what breaks the RSI, and then that's going to be exploited because RSI do not like to be oversold or overbought, especially on the daily. That in a nutshell is what we're doing. So you'll notice that when you look through these plays, that you'll see a gap down on earnings followed by the broken RSI. It's like a line down, one horizontal line down. Or not horizontal, vertical line down. You got a straight line. The E right there is blocked by the red square. Let me turn this shit off. How do I turn it off, Dad? No, I want it off. That's the weekly. And again, I don't really like the desktop too much other than charting. I'm more used to the phone version. So anyways, that blue E there is the earnings period. But you'll see this setup on most plays. And that's, that's another good thing, because you're going to say, oh shit, this is consistent. It's a consistent strategy. That's what you want. So SI met the criteria. We played it today. Money was made. That's that. Now, as far as the average hold time, it varies. You need to stop. Don't think in momentum. Or I'm sorry, don't think of price targets with this. Think about momentum. If you buy your call or your put, and then you get like a surge of momentum in the direction of your contract, that's good. And you should probably take that profit before it stalls out, and then theta catches up to you, and you start losing money. Now another thing, I'm not going to get into the options chain yet. I'm going to show you several of these so that you can burn it into your brain what it looks like. Let me clear all these other indicators off real quick. MACD off, RSI off. This is it. So this is your ideal setup. Daily chart, scanning for gaps. The RSI it's already going to be broken. You'll already know that because of the screener, and it's already going to be coming fresh off of earnings. So literally, you're just looking for one thing on the chart, and that is a daily, or if you have to, 4-hour gap. So that's SI. Let's look at SFBS. And again, this is what every member should do, because again, yep, there's one. That's super pretty. So again, here's another one. We had earnings 2 days ago, gap down, and this one did not pan out immediately because guess what? Did this one break the RSI? Sure didn't. It's still above it. Did this one break the RSI? Yeah, it did. It's 26.96, and then we had today, which is 28.13. I'm sorry, this one was 27.61, 26.07. So although this gap occurred on earnings, it did not break the RSI. So if you were, familiar with core, you would know not to buy it yet because it's not oversold and it would not have shown up on the screener. So this play here is on the screener as of yesterday. This showed up. So it didn't show up the day before, it showed up yesterday. And that's why the screener is badass, because it prevents you from accidentally buying before it's oversold or overbought in the case of puts. So that's SFBS. Definitely a contender for the core logic. Next we have HIFS. And you're going to want to check all these. Like, just because they show up on the screener does not make them automatically a play. You have to be responsible and go look yourself and make sure that everything fits based on what I'm describing here. Here's one here that meets an example. The RSI is broken. You have some gaps in the chart, but not a gap created from recent earnings. So that's a problem. Let's go to the 4-hour now as a last resort. And the RSI is not broken. This one's a no-go. HIFS, not a go, not a play. So 2 out of 3 here met criteria. Let's go to the put side now. And we have a shit ton. So immediately, what I noticed, because the put side has been very light as of late. There's been nothing showing up on here. So whenever I saw all of these financial services sectors show up, I thought it was strange. Then I got into WAFD, and I sold a little bit too early. I still do this even after a year. I'll sell early because I feel like, oh fuck, there's no way this is gonna work out, and then core always wins. So these are your puts for today, and a put is the same as a call. It's the same exact criteria. It just seems to, in my experience, take a little bit longer for your put plays to come to fruition. So Interactive Brokers, IBKR, daily earnings was here. We have a slight gap very slight, but the RSI already is back from overbought. So IKBR or IBKR will not be on the screener today, so we can go ahead and remove this out of sight, out of mind. It doesn't fit as of right now. FHN, this one had a gap on earnings, but even this mofo is going to be off the screener today, 69.84. So these financial services ones that just popped up, considering the bank earnings we just had, I think that's an anomaly because again, since creating this screener, I've never seen this many financial services pop up at the same time. It's rare that you see one in general. Let's go to FNB. No gap. RSI is not over. So all of these are going to be off at the screener. So this one's not a play. Let's go to WAFD. Is that one still a play for tomorrow? Ooh. Oh, almost. But you see how WAFD, how it gapped up on earnings and everything looks good for core. It gapped up. The RSI was overbought, but it just takes a little bit longer to come to fruition. So obviously your floor for this one's going to be here. The top of the gap. The top of the gaps is your support for up gaps, and then the bottoms of your gaps are your resistance for the calls. So that's FNB. I'm sorry, WAFD. Let's do CHCO. No gap. RSI's overbought. Let's check the 4 hour. No gap. No go. And the RSI is broken on the 4 hour. No go there. CAS. No go. But anyways, you get the idea. It's the same shit. It's just literally three things. If the RSI is broken, if it's over 70 or below 30, that's one thing to check off the list. If the earnings have just occurred, another thing to check off the list. If you're using the screener, it checks those two things off for you. The last thing you need to do is just manually, with your own eyes, as for the time being, I'm still waiting on the tools I need to be developed so I can create the automatic gap screener too, so we don't have to look for anything. It'll just shit plays on our desks every day. But that's basically it. The gaps is all you're looking for. So once you confirm that everything looks good, let's go back to SI. And let's say we're thinking about getting into this play. We're going to the screener. We see SI. It's looking good. It's on the screener. It meets all criteria. What's the next thing you do? Well, the next thing you do would be to go to your options chain. So when it comes to your options chain, there's a few things to look out for. One is going to be the bid-ask spread. Never buy the fucking ask if you're playing level 2 options. It's the dumbest thing you can do. You're leaving money on the table, and if the spread is wide, you're super fucking yourself big time, because sometimes these spreads are hundreds of percentage points wide. There is a way to game this, and you have to set 2 orders. And another thing, always buy in the money. Once you get experienced enough, then you can try to go for some of those at the money swings that are closest to the current price, but not technically in the money. You know, that's fine, but to get started with this and to have the best optimal win rate possible, stay in the money. I fucked myself many times by going against this rule, and that also brings me to the exit strategy. How do you know if the trade's bad and when to get out? Well, okay, let's say you bought SI today at $55, and the stock drops to $54.80. Get the fuck out. If you get pushed out of the money, get out. You'll have minimal loss. There's always another core play, and you may have just timed it wrong. There's always better to take and get out and assess and try again than to just sit there and average down on a trade that's bad. So my rule of thumb is always exit if pushed out of the money. And same goes for puts. If you were to buy SI and it was on the put screener and it was let's say SI was trading at $60 and you bought your put for 60. Let's say it was trading at $61 but you bought puts for 60 and the price went up above 60. You get the fuck out. That's your signal to get out, and that happens 15% of the time. And sometimes they're just bad trades. Sometimes you won't get pushed out of the money and you still won't earn. It just depends. It's not 100% win rate. It's 85, but that's way better than a coin flip. So that being said, don't ever buy the ask. If you look and you notice my option columns, I don't even have the ask on here because it's not anything I'm ever willing to pay. If you're going to sell options, level 1, which is where everyone should start with options, but no one does, that's when you should be hitting the ask. Sell the ask, buy the bid. Sell high IV, buy low IV, which brings me to the next thing to look at. As far as these columns here, the only real things you need to pay attention to are these first 5, and I have my first 5 things aligned as follows. First is volume, then you have open interest, then the bid price, then the mid price, then the implied volatility. Now, what is a good implied volatility for a stock? There's no technical answer for that. So what I've found to be the best way to go about this is if you're in the group and you want to know if the IV for a specific stock is high or low, because you can't compare stock IV to another stock. Stock IV is only relative to itself. So the command you would do to do this is the IV percentile command in Discord. IV percentile, and then type in SI, and then see what it returns. Look, right here, 13% from a 90-day horizon, as far as measurements of IV, have been lower. Only 13% of IV measurements have been lower than the current IV. For the 30-day horizon, only 38.55% IV measurements have been lower. Let's check something like MULN, MULN. That's a high IV stock. Percentile MULN. May not return that one. For some reason, NASDAQ data link doesn't like to. Yep. Doesn't have MULN. That sucks. Let's do. I wonder what GameStop's is at. But this is how you check it. This is how you compare it against itself. GameStop, see, okay, so 70%, 7.68% of IV measurements have been lower for GameStop, meaning the current IV is relatively high. But if you look at the year out, which again, any apes watching this show, I told everyone at the beginning of this year it was going to be the slaughter of the apes. And 2023, as Ryan Cohen said himself, is going to be the year for GameStop. I don't know what's so hard to understand about that. And it's in the data too. Because look, the IV percentile is lowest when you get to 2023. And it gets lower as you go on and further out in time. Except for the 60-day, which is towards the end of this year. But this is how you verify the IV is low or high compared to itself. That being said, that would make sense that the 95.34% IV, although high from a general standpoint, it's technically not high relative to itself. Because as we just saw from the command, if it's less than 50, you're probably in a good spot. So if these numbers here show up less than 50, the IV can be considered low, in my opinion. If it's above 50, it's pushing the high side. But that's it for options chain. You're looking at implied volatility, measuring it to make sure it's not too fucking high. And then the next thing, don't ever buy the ask, buy the bid. If you're going long on calls or puts. And by the way, buying puts is not shorting the stock. So if anyone thinks that, you need to get that shit out of your head. Buying puts is not shorting a stock. It's buying puts. If you buy puts, you are long puts. Now, the only other two things to look at is real quick, open interest and volume. Now, the way you can think of this to interpret it, volume is your offense, open interest is your defense. On the call side, open interest is your resistance. On the put side, open interest is your support. So, a good way to measure this is to do the following. You see this? That's your defense for open interest, or your resistance, right? And then you look at the open interest on the put side. Is there more support or resistance? There's more support. So if the support is above the resistance, then the price is likely going to go up when you're dealing with these specific illiquid, low volume, low trading stocks, because they're tied up in collateral baskets in the reverse repo and other forms of collateral chains. So we go down the list. What's more? 2005 versus 567. 2005 wins. 1100 versus 635. 1100 wins. 639 versus 440. Sport wins. It's not until you get to 75 that the open interest is higher on the call side. So, that being said, this would be my ultimate ceiling, not for tomorrow, obviously, but this was probably written way back when. Let's actually see when this contract was written real quick. It was written in, actually it was written in August. So they were draining premium from August all the way down to current day. Another thing about expirations. So if there's one fucking day left until expiry, don't buy it. It's stupid. Theta will eat your asshole. Now, even if you're in the money, it will hurt. Now, the reason why we buy in the money is because you have intrinsic value. If you buy these out of the money and they're slow movers, which oftentimes many of them are, theta will eat away at your gains faster than the stock will move up. So you're always going to be, theta's bitch. Because to beat theta out of the money, you have to have momentum. If you do not have momentum and the expiration is coming up towards the day of expiration, theta is going to get stronger. So you're going to need more momentum. And the further out of the money you are, the more momentum you're going to need, and the more theta is going to hurt you. So the closer you get, just think of the walls closing in. That's basically what it is. So obviously, you want to give yourself time. Typically speaking, if you notice, you see how these expirations are a month apart? Typically speaking, core plays will be monthly expirations, meaning you do not have to worry about weeklies. This makes it very easy for strike selection because obviously we're not going to buy tomorrow for SI unless we already did this week, but if you did this week, then you profited because hopefully you sold in today's momentum run. But if we were to look at November of 18th of the next month, and we look and do the same thing we just did with open interest, you can see that support is higher than resistance. The current strike, next strike, it's a little bit higher, and then we stop at 65. So is that saying that this may run to 65 next week? No, it's just something to look at when analyzing these option chains for core. Because if you see something like 4,000 open interest on the call side, and you're looking to play calls, and the price is right at that strike price, chances are you're not going to go any higher than that price. Because, again, the open interest on the call side is your ceiling. Like, for example, looking at this chain here, you wouldn't expect it to go much further than 70 because there's no support there. There's only resistance. So it would be hard for this to pass by 70 without significant volume. And considering these are low option stocks, that's likely not going to happen. You had 1 million volume today on this one, which is relatively low. You always get the most volume on the gap downs from earnings. But that's basically it. That's all you need to do to walk through this as far as play selection. That's it. RSI. I'm not even bringing up the MACD right now. Just the RSI, the earnings, the gap. That's it. If those are all there, boom, go over to options chain. Is the IV high? Is it high or low enough for me to play it? And if you're in the group, then I would just use that 50% mark on the command output. If it comes in lower than 50, most of the time you're good. And another thing I like to do, which I kind of forgot to mention this, if you go and you do the fib command, which I think this is kind of funny, /fib. Another thing I like to do, just to add a confirmation metric to this, look at SI. The fib's near the bottom or the 1 year low, right? Now let's look at WAFD. The fib is near the top. So you have your calls here, and you have your puts here. See how they're opposite? That's what core is. It's like the call side of core is the same as the put side of core. There's just a small difference, and then it takes a little bit more time for the puts to come to fruition. And I think a lot of that has to do with, I've been trying to figure out why, and I think that it has something to do with ETF pairing. Because as we saw, WAFD moved with SPY all day yesterday, most of the day today, until when? After the fucking repo, and then they went their separate ways a little bit. So it's very interesting stuff. And this strategy will be viable until the repo demand comes down. Once it hit that over that 1.5 trillion mark back in I think it was September last year, around this time last year, that's when I started noticing the consistent chart setups appearing how they were, how I just showed you, which is this. This is it. This is your setup. Ideal setup right here. Gap, down or up, broken RSI, earnings. That's it. In the money, low IV, always buy the bid, not the ask. if you need to, if you're trying to time your entry, which I get a lot of questions about this, there's not really a way to answer that. Because again, that's when it gets individual, because a lot of people like to do different things when it comes to timing orders. Me, I personally don't even think about it anymore. I like to reference the options chart. So like SI here, if I were thinking about buying this tomorrow, look at the chart. You can see that it's basically fucking bottomed out right here, right? At 5.56, it had a low of $5. So you're buying it near the bottom if you go ahead and get it tomorrow off the open, which a lot of the times, honestly, lately, I've been just buying these off the open. Especially if, the chart from the options chart agrees with that. So, I mean, yeah, that's basically it. And then your screener updates daily. Corporate actions, that's another thing. Corporate actions, let me bring that up. So every now and then, whenever there are legitimate puts on the screener, you'll notice that there will be sometimes gaps up that kind of consolidate for a while. Well, hopefully I took care of that, because I don't think we've actually ran into any of those since I've put the screener in. Let's just go through these real quick and just check that there's none there. Because if there was, that'd be good, so I can give you an example. Middle field bunk. No gap there. 4 hour. No gap there. No go. Let's do CAS. No gap. Oh, that's 4 hour. Hold on. Daily. No gap. No go. The put plays are shit. The calls have been badass lately. EQBK. And this should update momentarily. No gap. But, okay, so let's see. Let's check the 4 hour. That looks like a perfect core exploit. Nope, no gap. Wow, interesting. Did that one hit overbought and then immediately corrected to fair value almost? But anyway, let me show you the corporate action example I have from the command in Discord. Oh wait, I can't run that one. Let's do learn. And anyone wants to learn all this stuff that I've been talking about is several places in the Discord. Several. You have forums that discuss this, videos. There's commands that explain this, like /learn core logic that shows this. Okay, thank God the password's not there. But then you click here for core, and then it reiterates everything that I just said. Alpha screener in plays, what to look for, stay in the money, the exit strategy, never buy the ask, avoid corporate actions, which is what I'm going to go over now. Avoid corporate actions. This is what you will notice when you look at a corporate action. They typically happen on puts. So if you see a play on the put screener that looks like this, it gaps up, there's a big ass gap with small candles above it, that's a corporate action, and I would avoid it because it's not your typical core criteria. Despite it being and appearing like it does meet criteria, it's actually different because it gapped up due to the corporate action, not because of earnings. That's the only difference. And again, you can also reiterate things like avoid weekly expirations. And then I give you an example of the open interest output. This is a weekly example. This is a monthly example. You're going to notice that there's less expiration dates than the weekly option chains. And then I think if you also want to do your WeBull setup, I think there's stuff in here as well for that. Oh, this is the same thing. Hold on. Oh, it's setup /setup, right? Or view. It's one of these. I've made too many commands. View setup. WeBull analysis tools. That's another good one. Yeah, right here. Options chain setups. You got your option chain setup, analysis tools, order types, option strategies to look at if you need to. And you also have order flow, positions, cost, top options list, the options chain, things like that. Yeah, I'm going to go ahead and I think I have like fucking 10 minutes to maybe take some questions before my wife gets back. I'm trying to think if I've covered everything. We went over the why it works, institutional ownership, and all that. I could add that just so you could see it if that would help. I could add this to the screener, but I just don't want to fuck up this. This has been a perfect screener setup. Oh, yeah, no healthcare. I forgot to mention that. The screener has built into it no fucking healthcare. It will fuck you. All of us in the group have gotten fucked by it. I think it's one of the most bogus sectors in the whole market. It takes up the majority of the market, specifically biotech. So I would stay away from healthcare, which is why you don't have to worry about it from the screener because it's already filtering out healthcare. So yeah. Oh, and by the way, how you know that they're shorting the markets with repo is look, net other assets. This is SPACs, negative 0.72%. How the fuck would you be negative on your asset reporting unless you were short? You wouldn't be. So while that's a small number, think about how much money they're holding in there. Fuck ton. Shit tons, man. It's crazy shit. But yeah, this shit works based on the current situation. And it's only going to work until the repo comes down. Anyways, anyone have any pressing questions in YouTube chat? Let me go bring that up. Where the fuck is it? All right. What questions do we have? Let me pop this shit out real quick. I mean, it should be pretty self-explanatory. I mean, we've been doing this for a year. It works very well. Anyone have any questions? Yeah, and anyone out there that's a keyboard warrior and thinks they're cool because they can type things that, you think you're making me mad. Bro, I don't fucking care. Like, you sit on the internet all day and you watch people's videos on live streams and you troll and talk shit. Like, if you have nothing better to do, that's on you. But if you want to see, the cost of this group, it's a fuck ton. The whole point is, I'm not taking people's money and pocketing it, taking it and reinvesting it into data products that we can use to better our trading regimes, which will increase our profit potential, which will better our situation. So, I mean, if that's not something that sounds good to you, keep jacking off on the live streams. It's whatever you want to do. Is there any questions, though? I'll be happy to help answer questions. By the way, I mean, if anyone's here that DRS'd, you did, very easily proven, give up your SIPC insurance to beg for the market to crash, which makes no sense. So please think for yourself and stop letting these morons control your thoughts, because they don't even know what they're talking about. And again, not open to feelings, just facts. I don't know. I'm just explaining to people in the group. I never call out anyone specifically. So it's just general statements. Because again, you got to remember, I've been dealing with bots and shills and bot farms and all these other non-humanoid entities. So yeah, man, I'm just trying to show you that it works. It works, and it will work until the repo demand is down. So I mean, if you're in a bad spot, if you've been fucked over, if you're bag holding, and you don't know why things are happening the way they're happening, I mean, what do you have to lose to come and try to figure it out? Because again, you won't ever figure shit out if you're looking online at news and social media. Because again, no one wants to work. Everyone wants to sit around online and talk. No one wants to work though. Because it's a lot easier to sit around on social media and talk and pretend like you know what you're talking about, gain followers, get ad revenue. You're basically employing these people to waste your time. So again, it is what it is. Okay, so about the repo and the inflation. Let me go over. That's a good question, and this is totally theory based on my research into this. But if you look at the repo market, let's look at it. If you look at it, let's just go ahead and compare some dates real quick. So this is the repo market from 2013 to today. If you look at it, there's some very telling things about this chart. One, you see the repo spike here. This is March of 2020. Well, what happened in March of 2020? That's when the first stimulus check talks were coming out. All the stimulus money was printed between March 30th of 2020 and March 30th of 2021. Between those two times, all 4 stimulus checks came out. So if you look at this, what else do you notice about the stimulus check time frame? Well, let me go over here real quick. Zoomed in too far. You see how there's a big gap in repo demand? That's when the fucking SLR was implemented. That's not a coincidence. That's when the stimulus checks were issued. Between here and here. And then guess what? Right when SLR ended, kaboom! Record repo. What else happened with the repo? This is where it gets interesting. So repo demand started to splurge right around April 1st, right when the supplemental leverage ratio expired. And very briefly, what that is, the supplemental leverage ratio, it freed up bank capital and allowed them to continue lending to risky companies who, needed the loans, and they were basically allowed to leverage the whole entire fucking market by stuffing their assets with money market funds, which is exactly why you see BlackRock, Fidelity, Vanguard sitting on multiple trillions of dollars worth of assets under management. So you have that. That's one thing. Now, let's look at the U.S. inflation numbers. Well, okay, so looking at this table here, let's go to 2020. What was inflation in March of 2020? So this column here is going to be March. Well, in 2020, we had 1.5 inflation. And look, low inflation, low inflation, low inflation the whole year of 2020 up until when? Fucking April of 2021. So now, I don't know about you, but if we take this and we put it here and we go and look at those dates so I just showed you, and we look at the inflation numbers from 2020, pretty low, and we compare it to what's now, it doesn't take a fucking rocket scientist to see that the inflation started when the repo demand started to surge. It's hard to argue this because, again, let me show you. And it's not a coincidence because all of the monetary policy that aligns with this as well, that's one hell of a fucking coincidence. And the fact that somehow mysteriously inflation's still record high, so is the fucking repo. You got to think a little. It's none of this is coincidence in my opinion. So we have 2020 in yellow. 2020 in yellow. So low inflation. 2021, it's low also. Until when? Literally in April, the same fucking time that this repo demand starts to surge, we see inflation nearly, it does double. No, it almost doubles. Almost doubles. Sorry. I am retarded, but not that retarded. So this is when we start seeing the big jumps. We go from 1.4 back to 1.2. Let's go down the line. 1.0 to 1.3 to 1.4 to 1.2 to 1.2 again. Up to 1.4, back down to 1.2, back up to 1.4, up to 1.7, and then it jumps to 2.6, and then to 4.2, then to 5.0, 5.4, 5.3, 6.2, 6.8, 7.0, and you can then drill down on this shit further to the fucking rate hikes, and that is when they jump. FOMC meeting rate hikes. This is not coincidental. And then now you're looking at this. When did the historic repo hit? 2022, 9.1. What month was that? Let's find out. 2022, 9.1 was in June. When did we have the lowest point in the fucking year other than this last couple of weeks? Fucking June, right? For the SPY, which was, you can tell by the dividend. Dividend marks the spot, right? Right here, June 17th. 360.69. That was the low. That was the low for the year. But it was the high of the year for inflation. Now, why is that? Because short fucking interest. They've been shorting everything since the beginning of the year. Really, further. But you see it right at the beginning of the year. Boom. Everything goes down, but inflation goes up. It makes no fucking sense. No fucking sense. If the markets were what was leveraged, right, you would expect inflation to go down with the markets. Well, they were leveraged, but they've been deleveraging the market, and to do that, they've been shorting it. You all know who they're borrowing from, but that's basically, a long-ass fucking answer, response to your question. The reason why the inflation or the repo has to come down is because it is the inflation. Everything ties up to it. You don't have low rates, low inflation in 2020, low inflation, low rates, and then magically, and the market is up. So think about this. Market is at all-time highs around, this time last year, we saw some all-time highs, and inflation was going up. In 2020, we ran to the tits. It was a great year because, again, we were on leverage. Stem 1, these green lines are stimulus checks, 1 through 3 and 4. They happened during the big-ass uptrend. It was a Hail Mary play, baby. And they planned this way back in fucking August of 2019. All of this was planned. Every single bit of this has been planned. All of it. So these people, like the top 10% of American families trade shares in the stock market. So, I mean, think about it. If this is a big wealth transfer, how are you going to transfer all the wealth in such a new, highly regulated, transparent market? You're going to hide it in the fucking repo market, which is exactly what they did. Fed's got the cash. Money market funds have the collateral. So if you want to know how inflation's going to look coming up, look at the repo. It's literally the tell for everything. It's reported at the same time every day. 12:15 Central is when it's reported. Window opens 45 minutes before then. But yeah, look at the repo. I wanted to see, okay, so the highest point here, that was 1904 at the end of the year. Let's go a little further. Let's do 2022 0617 to, oh shit, to today. God damn, that's annoying. June 17th there. We got September at the end of the year is the most repo, obviously. That's expected. If you haven't noticed already, at the end of every quarter, end of every fiscal year, the repo has been jumping since it's been a thing. But yeah, they got the whole market right now in a cage with the volatility. And they're stuck between a rock and a hard place because on one end, you got the inflation, which technically is the repo, and to counteract that, you got to short the market. So by shorting the market, you're creating more inflation. By creating more inflation, you're making basically a lot of pain happen for people. But that's why they spin this bear narrative. If you don't think they're not gonna inject all this money back into the system when everyone's like had enough pain and everyone's out and everyone's turned and converted into a bear, that's exactly what they're gonna fucking do. This is the wealth transfer right fucking here. And we financed it. It's a bail-in. It's got student loans, airports, bridges, highways, schools, you name it. It's in here. And it's all in the web of ETFs and their big-ass interfund lending system that's approved by the SEC. None of this is illegal. All of this is legal. There is no crime. If there is crime, it's handled by the SEC and the whistleblower program, and then they're paid their dues for, being the fucking SEC. Gary Gensler's worthless. He was put in office right about here, right when the repo demand started, because they needed all these distractions. And so far, they've done a fucking great job, because nobody talks about this shit. No one. And there is another end to this. There's also the standard repo, but hey, I actually gotta go. My wife's home. Oh shit. But yeah, hopefully this answered a lot of questions. But yeah, that's why from a fundamental market perspective that this works. And inflation has to come out. Because, I mean, if you think about what they literally did financial genius because they needed the SOFR rates, which is what this is, secured overnight financing rates that are forward-looking for foreign entities. It all ties into China. It all ties into everything. Everything, like basically, if you want to put all this situation in a nutshell, they created a hole so fucking big that they had to take the entire fucking planet and it basically dragged the whole world down in this hole with them, and the only way out is through collaboration, basically, which is what you see here. Because if you look, let's go to this. Let's look at the countries they're exposed to. Fidelity Government Money Market Fund. USA is number one, obviously. Japan, France, Canada, United Kingdom, Germany, Switzerland, Australia, Netherlands, Sweden, Norway, Belgium, Italy, Denmark, Supranational, which is interesting in and of itself, Singapore, and Spain. Some of these haven't had any transactions for a while, but the majority of the main one is, our go-to proxy, Japan. But take a look at why the fucking Japanese yen has been tanking as of late. Because the repo demand has been tanking with it. Ever since the first of ever since SLR, it's all been backwards. Guess what? Japan's going down while we're going up. It's all a big game, and everyone's complacent. Everyone's asleep. Everyone's playing the games that they want everyone to play. I'm an ape. I'm this. I'm that. Instead of being themselves an individual and realizing, holy fuck, this is all bullshit. Because they tell you it's all bullshit. They've planned every ounce of this, including DRS, all planned. They said, we're going to incentivize the use of DRS in 2021. Well, they sure as fuck did that. So, again, I mean, you can deny it all you want, but the reality's there. And if you ever want to find it, it's out there for you. That's the beauty of it. So, anyways, I got to go. But thanks for everyone for tuning in. Hopefully that explains some shit. And again, I mean, it's consistency. You do it the same way every time, you're going to find wins. And it will help you out in other areas. Maybe you're a trader and you've been in a slump lately because you have no idea what the fuck's going on in this market, which is understandable. Consistency can help you find your way. So again, and you don't have to be in the group to play this. I mean, anyone can do this with a computer screen, internet connection, and that understands what I was just talking about with these indicators and the setup and what to look for. It works, and it's been a proven track record. So again, hopefully this helps people out there. That's what the goal is. The goal is to get people out of the mindset that, oh my God, I need to rely on the internet for information regarding stock trading. No, you don't, because the tools that were just created while everyone was playing ape is fucking incredible. And again, it's an amazing time to be alive, and I would definitely start harnessing the power